Building wealth entails more than earning and saving money with each paycheck. Another strategy to increase your wealth is to invest in assets that create income for you. This way, your money increases passively without requiring you to actively work for it. Time is valuable, and every minute you make passive income is pure wealth for you. In this video, we'll go over 10 affordable assets in which you may invest to grow your wealth. Number 1. Stocks. Numerous inexpensive equities are floating around that might be terrific long-term investments. If you have confidence in your ability to analyze market patterns, you can rely on stocks to generate substantial returns. Having a plan in place will prevent you from acting rashly in the face of joy or fear. The two primary kinds of investment strategies are fundamental analysis and technical analysis. Certain investors use a mix of the two, and your approach can include other variables such as exposure to international equities. You'll need to choose the degree to which you want your investments to be aggressive. By investing in actively managed funds, you may delegate part of your investment responsibilities. Index funds, which track a benchmark index, such as the S&P 500, are considered low-risk investments due to their great diversification. Purchase both stocks and exchange-traded funds, or ETFs, to help diversify your portfolio. Because quality long-term assets often outperform the market, it is generally prudent to keep them. Regardless of the market's direction, you should continue to contribute to your investing account. The larger your capital investment, the wealthier you can get. Use market data to guide your investment selections and eliminate some of the guesswork associated with stock market trading. Number 2. Bonds issued by governments and corporations. Bonds are basically loans between an investor and a borrower in which the debt must be repaid in installments over time. They are more stable than stocks and shares, which makes them a more secure investment. Bonds are a kind of financing used by organizations to generate money. There are two methods to profit from bond investment. If you purchase bonds for $10,000 and sell them for $11,000 when their market value grows, you can keep the $1,000 difference. The majority of bonds are not exchanged openly, but rather over the counter, which requires the services of a broker. Bond values are less volatile than stock prices. State, city, and other local governments also issue municipal bonds to fund public projects and services. Bonds are an excellent method to diversify your portfolio and hedge against market volatility, but because the bond market is less transparent than the stock market, you may have a tougher time assessing whether the price you're offered for a particular bond is reasonable. Number 3. Commodities. Commodities are raw resources that are utilized in a variety of sectors to manufacture items and provide specialized services. Traders can purchase a variety of commodities, some of which are more economical than others. Oil is a commodity that is used to manufacture a wide variety of products and services. Base metals such as zinc and copper are a cheap commodity to invest in. Commodities can be very volatile, therefore it is critical to understand the risks before investing. Prices increase as demand increases or supply gets constricted. They decrease when demand decreases or supply increases. The most risky businesses are those that manufacture at a high cost. If prices decrease, they risk going bankrupt. Commodity investing may be accomplished in a variety of ways. The leverage effect implies that you may quickly make or lose a fortune trading commodities futures. ETFs are a handy method to invest in a single commodity or a group of commodities. They expose you directly to commodity and market-based pricing, which means you're more likely to get the greatest price for your assets when the time comes to sell. Commodities are low correlation assets, which means you are not excessively exposed to any one company. They may be used to diversify a portfolio, so reducing risk and smoothing out returns. Bear in mind that price increases are often transient, which means that commodities may not be ideal buy and hold investments. Number 4. Deposit certificates. These are financial investments that are often made available via banks and other financial organizations. These rely on investors lending money to a bank, which earns interest on the loaned funds over time. Depending on your bank, this asset may be a cost-effective strategy to generate passive income. When interest rates are low and inflation is high, it might take time to accumulate money via certificates of deposit, or CDs. CDs provide a greater rate of interest than savings accounts and are insured by the FDIC. With CDs, you can create a ladder structure for your assets and then forget about them. You can acquire CDs online or in person at a bank branch and arrange them in a ladder structure. As each CD matures, you can roll it into a longer-term CD, retaining simple access to your money. The worst-case scenario with CDs is small inflationary losses, but you will still have more money in nominal terms. Number 5. Residential rental properties. Renting out homes for a fee is a well-known method of generating consistent and predictable passive income. Consider renting out a property that is being sold cheaply and is in excellent shape through services such as Airbnb and other rental applications. Borrowers are often required to make a 20% down payment on a rental property mortgage. Being a landlord involves a diverse set of abilities, from understanding tenant law to repairing a leaking faucet. Experts advise keeping a cash buffer in case of an unexpected loss. In general, investment properties demand a greater down payment than owner-occupied homes. If you have student loans, have outstanding medical expenses, or have children about to enter college, acquiring a rental property may not be the best investment at the moment. Consider an area that has inexpensive property taxes and a variety of facilities. While money might create a positive cash flow on a monthly basis, loans can yield a higher rate of return. A mortgage for a rental property is essentially identical to a mortgage for a principal house. Borrowers will almost certainly face stricter credit score requirements and debt-to-income ratio requirements for rental property financing. Discrimination in mortgage financing is banned. Individuals should aim for a 10% return. Annual maintenance expenditures should be estimated at 1% of the property's worth. Costs like pest management, landscaping, and routine maintenance for repairs should be included. Consult your insurance agent to ensure you have the appropriate coverage, or rather, look for a property that is priced below market value and requires just minimal repairs. Condos may be an attractive alternative for rental property purchasers due to their affordability. Owners of rental properties have the option of managing the property themselves or hiring a property manager. It's a difficult choice, since managers often charge between 8 and 12% of collected rentals, which eats into earnings. The expense of hiring an expert property manager may be well worth it. Investing in real estate can be an excellent method to generate passive income while maintaining a full-time job. Interest paid on a loan for investment property is tax-deductible. If you lack the necessary funds or skills, you may want to explore forming a real estate partnership. The majority of borrowers are required to make a 15 to 20% down payment on a rental property. Rental property mortgages have a greater default rate than main residence mortgages because financially distressed borrowers prioritize their primary residence debt first. While condominiums are often less expensive than similar single-family houses, they are more difficult to finance. By the way, we're on a mission to help people like yourself make billions, so make sure to subscribe if that sounds like you. Number 6, REITs or real estate investment trusts. If the real estate market is too dangerous for your risk tolerance, you may want to consider real estate investment trusts. Money is pooled amongst investors with the purpose of purchasing and selling more rental properties. You gain from the real estate market while assuming less financial risks. REITs are gaining popularity. The most dependable REITs have a history of delivering substantial and rising dividends. Nonetheless, growth potential includes risks that differ according to the kind of REIT. Because REITs are not subject to corporate taxes, they may expand at a quicker pace than non-REIT businesses. Publicly listed REITs often provide more transparency and the most liquid shares. Purchases of these REIT shares may be made via a broker that participates in public, private, or non-traded offerings. The SEC notes that these REITs often do not provide investors with an estimate of their worth until 18 months after the offer ends. You can invest in real estate investment trust mutual funds and exchange-traded funds to provide immediate diversification at a low cost. While REITs are tax-exempt, their investors must pay taxes on any dividends received unless they are held in a tax-advantaged account. Investments in non-traded REITs may need a minimum of $25,000 and may be restricted to accredited investors. Number 7, individual savings accounts. This may seem like an unexpected choice, but savings accounts are among the safest investments. They appreciate at a slower pace than the other items on this list, and their value fluctuates. However, they might be advantageous in situations when you want to save for another item or establish an emergency fund. Number 8, collectibles. This is a risky investment since it is dependent on the item, but it may result in some significant rewards in the future. This category includes collector cards, coins, and even travel stamps. Even wines and spirits may be profitable if they are offered to the appropriate audience. Number 9, crowdfunding. This has been a popular method of investing in small firms and startups in recent years. Crowdfunding websites are flooded with fresh startup businesses seeking investors. With a little study, you may be looking at a new stream of revenue. Number 10, homemade goods. Finally, and maybe most importantly, the most essential asset to invest in is yourself. You can start your own internet business by creating a podcast, a website, or even an ebook. Although they need your time and effort to create, digital items are an excellent way to earn money quickly. And if you found this video useful, then you'll love these. And be sure to like this video to let the YouTube algorithm know you'd like to see more videos like this one.